Extraordinary monetary policy moves during the pandemic have motivated investors to find new opportunities for mitigating risk. We talk about it day in, day out. Well, another great voice, Dwight Scott, global head of Blackstone's GSO Capital Partners, spoke exclusively with our Sonali Basak. Here he is.
Well, I worry about the fact that rates are so low today that the wind that's been at our back as investors for a long, long time of falling rates, we don't have that in the credit markets. Now, investment grade is inside of 2%. So you're getting duration risk. So you're making long-term investment decisions. And you really don't today know how long rates are going to stay this low. So I worry that as you see rates start to tick back up, which I don't think is going to happen in the real near term, but over time, as those rates tick back up, those fixed income exposures you're going to have to be really careful about, because you're not getting a lot of yield to offset an increase or a decrease in pricing caused by an increase in rate. So I'm cautious about that.
How does that change the way you underwrite your expectations here?
Well, once again, it gets us back to this difference between the private world and the public world. On our public strategies, we are definitely moving higher in the value chain. We want better companies, better management, strong sponsors in our leveraged loan business, because we believe those businesses will outperform and they'll grow into their capital structures or grow into less leverage. So that's how we're managing that on our levered loan side, for instance. On our private side, we're able to kind of jump in there and take advantage of dislocation. So if a company is coming to the market, if a sponsor, a private equity firm wants to buy a public company, they can't really finance that in the bank markets because they need full committed capital. So we can step in there and provide significant capital. We did that for a large chemical acquisition in Europe this year, where we provided half of the financing they needed before they made their bid, and then they went out and placed the rest of it later. And so I think those kind of situations in this kind of market will be where we are more aggressive.
It's funny. I was about to just ask you, in the heat of the pandemic, what kinds of risks you're not worth taking, but you just pointed to an opportunity there. It's worth asking you then, what opportunities are you seeing to put money to work? What looks like the most investable opportunities?
Well, I do. We are seeing, I want to be careful because we are being cautious. We've been talking to our investors about this concept of cautiously active for the last 6 months. And what we've described that as, we are worried about where this pandemic leads. We don't really have great insight into when we'll be back in theaters or we'll be back on airlines. And so we've been cautious about that, but we've been active because the higher quality names traded off with the lower quality names, and we were able to invest in those, and the private market shut down and began to reopen, and we were able to invest in that. And so we believe that there's always going to be an opportunity. I'll give you an example. We did across Blackstone, so in the credit business, in our life sciences business, in some of our other businesses, we provided $2 billion to this company called Alnylam this year in the middle of the crisis in the form of a royalty, in the form of a loan, in the form of some equity. And that $2 billion was critical to that company to push through this cycle and to grow. And so I think we'll always see those opportunities, and we'll try to make sure we use the value of our platform, the scale, the broad nature of our products, because those things will give us those one-off, take a shot and do something really important in these markets. At the same time, we'll continue to make the investments in the public side of our business.